Usually, when we talk about a medical diagnosis, there's this expectation of precision,
Right, yeah, like it's clear cut.
Exactly. Like you break your arm, the x-ray shows a jagged white line, the doctor points right to it, and, well, that's it. It's binary. It's clean.
Yeah, you put a cast on it and you're done.
Right. But if you step into the world of global finance and macroeconomics right now, I mean, that x-ray machine is just totally broken.
Oh, completely. It's the absolute definition of, like, diagnostic muddy waters.
Yeah, we are looking at this landscape where the bones seem to be shifting in real time while we try to isolate the fracture. Like every single time you think you've pinpointed a symptom of currency dropping and interest rate spiking, you realize it's actually connected to an entirely different organ system you weren't even looking at.
Because the interconnectedness of modern global finance means you can't look at one chart in a vacuum anymore.
No, not at all.
A tremor in some seemingly obscure Asian debt market, it isn't isolated. It travels through the nervous system of the entire global economy in milliseconds.
Which is exactly what we're going to untangle for you today. We are pulling from two incredibly dense, deep in the weeds financial interviews to, map out this shifting x-ray.
Yeah, and the sources are fantastic.
They really are. The first one features macro analyst David Lin from a recent appearance on Mario Naufel's show. And the second features Jeroen Blokland, who is a Dutch multi-asset fund manager speaking on Holland Gold.
And what's interesting is both of these analysts are looking at the exact same murky data, right?
Right.
But they are pointing out these systemic fractures that most of the mainstream financial press just seems eager to ignore entirely.
So our mission for this deep dive is to connect those dots. We are looking at how a late-night currency intervention in Japan mechanically ties to, say, the interest rates on your credit card.
Which sounds crazy, but it does.
It really does.
Yeah.
And how it fuels skyrocketing gold prices, and how it all collides with this massive artificial intelligence industry boom to potentially alter the fundamental structure of capitalism itself.
It's a massive collision.
Okay, let's unpack this. Because to understand the sheer scale of what these sources are tracking, we have to start with a precipitating event.
Right, the yen.
Yeah, in late July and early August, the Japanese yen just went into absolute freefall.
I mean, it hit 164 against the US dollar.
Which is wild.
It is. To put that in perspective, that is the weakest the yen has been since 1986.
Wow. 1986.
Yeah. And then, seemingly out of nowhere, you get this massive, highly coordinated currency intervention. We're talking about $53 billion deployed into the open market to just stop the bleeding and force the value of the yen back up.
But the fascinating part isn't just that Japan intervened, right? I mean, sovereign nations intervene in their currencies all the time.
Sure. Yeah.
The revelation in the source material is that the United States Treasury quietly got involved.
Yes.
And the cast of characters here is, well, it's almost cinematic.
It really is. The sources highlight Scott Bessent, who was heavily involved in the strategy discussions for this.
And for anyone who follows financial history, Bessent is a legend. He was instrumental in working with George Soros back in the 1990s.
During the 1997 Asian financial crisis.
Exactly. They notoriously shorted Asian currencies, making billions by essentially breaking the Bank of Thailand.
Right. They did it by borrowing massive amounts of local currency, dumping it on the open market for US dollars to crash the local price, and then buying the local currency back at rock-bottom prices to repay the loan, and they just pocket the difference.
The irony there is profound. Like, the architect of one of the most aggressive currency short-selling campaigns in history is now sitting on the other side of the table trying to engineer a floor under the Japanese yen.
It's wild. And the sources point to this leaked, handwritten to-do note from Bessent at a Camp David summit.
Handwritten note.
Yeah, casually reminding himself to have the U.S. Treasury buy 5 to 10 billion yen.
I mean, on a $53 billion intervention, 5 to 10 billion might seem like a drop in the bucket. But the signaling to the global markets is deafening. It broadcasts coordinated U.S.-Japan panic.
Absolutely. And looking at the political calendar, David Lin's analysis points out the timing of this panic. A collapsing yen destabilizes global markets.
Right, it ripples out.
And a global market crash just months before the U.S. midterm elections. That is catastrophic for any incumbent administration.
So Lin's reading of the situation is that this intervention was highly motivated by a need to keep the financial architecture stable through November.
Yes, and to be clear here, Lynn is analyzing this strictly from a macroeconomic game theory perspective.
Right. He's not taking sides.
Exactly. He's identifying how political timelines force the hands of central banks, rather than endorsing any specific political party strategy. He's literally just reading the math of the calendar.
So the timing explains the urgency. But Jerome and Blockland's analysis of the mechanism they used, that's where the real systemic fragility gets exposed.
Because normally, if the Bank of Japan wants to prop up the yen, they need a massive war chest of US dollars to go into the foreign exchange market and actually buy yen.
Right. And Japan happens to have that war chest, right?
They do. They hold roughly $1.2 trillion in US Treasury bonds.
Trillion with a T.
With a T. So the standard operating procedure would be to sell a portion of those treasuries, take the cash, and buy yen.
But selling U.S. Treasuries on the open market is the absolute last thing the United States government wants Japan to do right now.
Exactly.
Like, if Japan dumps $100 billion of U.S. debt onto the open market, the supply of bonds overwhelms the demand.
Bond prices plummet.
Yeah, bond prices plummet.
Yeah.
And because bond prices and bond yields operate inversely.
Right. When the price drops, the yield spikes, the interest rate spikes.
Exactly. So the U.S. Treasury essentially stepped in and said, look, do not sell our bonds. We have a workaround.
And what a workaround it is. The workaround is the Federal Reserve's FEMA repo facility.
The Foreign and International Monetary Authority's repurchase agreement facility.
That's the one. Blockland highlights this as a brilliant, albeit terrifying, parlor trick.
Okay, break the trick down for us.
So Japan takes their U.S. treasuries and hands them over to the Fed. The Fed holds the bonds as collateral and hands Japan newly printed U.S. dollars in the form of a loan.
Okay.
Japan takes those borrowed dollars, intervenes in the currency market to buy yen, and the U.S. treasuries never actually hit the open market.
Okay, I want to use a tighter analogy for this so we can really picture it. Imagine you need 10 grand in cash immediately.
Right. A liquidity crunch.
Yeah, and you own a vintage Rolex worth 15 grand. You could sell the watch to your buddy, but that floods his little local watch market, driving down the value of his own collection.
You wouldn't be happy about that.
Exactly. Instead, your buddy tells you to take the Rolex to a pawn shop, put it down as collateral, and get a cash loan.
Oh, that's good.
Right. You get your money, the watch stays off the open market, and your buddy's collection maintains its value. Japan basically pawned the treasuries.
The pawn shop analogy captures the exact mechanics of the repo market perfectly, and Besson actually advocated for expanding this repo facility beyond its current $60 billion limit.
Wait, expanding it.
Yeah, because by expanding the limit, the U.S. is essentially advertising to the rest of the world that they will provide infinite dollar liquidity to any foreign central bank that just agrees not to sell U.S. debt on the open market.
But the problem with pawning your Rolex is that it's a bridge loan, you know?
Yeah.
It's not a permanent fix.
Yeah.
Eventually, you have to pay back the cash plus interest to get the watch back.
Precisely. This $53 billion intervention temporarily jolted the yen from 164 down to 155 against the dollar.
But it gave up half those gains almost instantly.
Right. It was a massive expenditure of capital just to buy a few weeks of sideways trading.
So it's a Band-Aid.
It's purely a temporary tourniquet. What's fascinating here is what this reveals about the U.S.'s fear. They are terrified of allied nations dumping U.S. debt, which would spike domestic interest rates. And they're equally terrified of what happens if the Japanese yen continues to weaken unchecked. Because a collapsing yen acts as the detonator for the largest accumulation of hidden leverage in the history of finance.
The yen carry trade.
Yes.
This is the $14 trillion time bomb sitting underneath the floorboards of the global stock market.
It really is.
And to understand why a currency crisis in Tokyo could theoretically wipe out the value of your 401k in New York, we have to explore the mechanics of this specific trade because it has warped the entire global financial architecture.
At its core, a carry trade exploits the interest rate differential between two countries.
Okay.
For decades, the Bank of Japan has kept its interest rates pinned at zero, sometimes even in negative territory, just to combat decades of domestic deflation.
So it's basically free money.
Exactly.
Yeah.
If you are a massive global hedge fund, you look at Japan and see an infinite spigot of free money. You borrow billions of Japanese yen from a bank in Tokyo at 0% interest.
And then you take those borrowed yen, convert them into U.S. dollars, and you look for yield.
Right. You might buy U.S. Treasury bonds yielding 4%. Or you might buy high-dividend tech stocks or funnel it into real estate.
The math is intoxicating. You are earning 4% on the asset, and your cost of capital is 0%.
Zero. You have engineered pure arbitrage.
But the profit isn't just in that little interest rate spread, right? It's heavily amplified by leverage.
Heavily amplified. The Bank for International Settlements, the BIS, effectively the central bank for central banks, they recently calculated that there are $14.2 trillion of yen swaps and forwards outstanding in the global banking system.
14.2 trillion.
Yeah. This isn't just hedge funds borrowing cash. It is a massive interconnected web of derivative contracts. Wall Street has taken that 0% Japanese money and used it to inflate the value of U.S. equities, European bonds, emerging market debt, everything.
$14.2 trillion. I mean, that is larger than the GDP of most nations.
Easily.
Entirely composed of synthetic leverage dependent on one single assumption, that the Bank of Japan will never raise its interest rates.
But that assumption is currently breaking down. As the yen plummeted to Kirchen 64, the cost of importing crucial goods into Japan, like energy, oil, food, it just skyrocketed.
Because they had to buy all that in dollars.
Exactly. Japan imports almost all of its energy. So a weak yen imports massive domestic inflation. The Japanese population is getting crushed by the cost of living.
So to save their own citizens, the Bank of Japan is being forced to raise interest rates to defend the currency.
And that's the trigger. Raising the interest rate strengthens the yen, but it instantly vaporizes the profit margin of the global carry trade.
Because your borrowing costs go up.
Right. If borrowing costs in Japan tick up to 1% or 2% and the yen simultaneously appreciates against the dollar, that global hedge fund is suddenly severely underwater.
The trade goes from being a risk-free money printer to a massive liability basically overnight.
Which triggers the margin calls.
Oh, man.
The hedge fund has to pay back the Japanese bank, but their capital is locked up in Nvidia stock and U.S. Treasuries.
So they have to sell their U.S. assets to get dollars, convert those dollars back into yen at a now unfavorable exchange rate, and close the loan.
Now, multiply that panic by $14.2 trillion. The unwind of the carry trade forces a massive, indiscriminate, and synchronized global sell-off of assets.
Meaning, the hedge funds aren't selling NVIDIA because the company had a bad earnings report.
No, not at all.
They are selling NVIDIA because they need liquidity right now at any price to survive the margin call in Tokyo.
And we saw the trailer for this movie on August 5th, 2024. The diagnostic X-ray flashed bright red.
I remember that.
On that Monday, following a minor rate hike from the Bank of Japan, the Nikkei index fell 4,451 points.
That's insane.
A 12.4% drop in a single trading session. It was the largest one-day point drop in Japanese history.
And the contagion immediately hit the U.S.
It did. It dropped the S&P 500 by 3% before the market even opened and sent the VIX, the volatility index, spiking to 66.
Just for context for you listening, the VIX rarely breaks 30 unless something is systemically breaking.
The volatility curve actually inverted that day, which indicates absolute panic among institutional market makers.
Wow.
And David Lin's analysis frames August 5th not as an anomaly, but as a minor stress test. A fraction of the carry trade unwound, and it nearly broke the plumbing of the global equity markets.
So if the Bank of Japan is forced into a sustained cycle of rate hikes, that exact playbook repeats, but on a scale that triggers a global recession.
Exactly.
But I have to push back here. Putting myself in the shoes of a listener managing their own portfolio. If Jeroen Blokland knows this, if David Lin knows this, if the BIS is literally publishing papers on the $14 trillion figure.
Right, it's public knowledge.
Why is the smart money still playing musical chairs? If everyone knows the music is slowing down, why hasn't the market naturally corrected to price in this risk?
It's a great question. The persistence of the trade relies on institutional hubris and the Fed put.
The Fed put.
Yeah. The smart money assumes they have superior risk management models. They believe they can detect the micro shifts in liquidity and rush for the exit 5 minutes before the rest of the market realizes the door is closing.
They think they're faster than everyone else.
Exactly. But more importantly, the foundational baseline assumption on Wall Street is that central banks will not allow a catastrophic unwind.
They expect a bailout.
They do. They believe that if the carry trade truly starts to detonate, the U.S. Federal Reserve will step in with infinite liquidity, cutting U.S. rates to zero, or opening massive swap lines to bail out the system.
They are playing a game of chicken with global sovereign debt, basically betting that the central banks will swerve first.
Yeah, that's exactly what it is.
But if the central banks can't swerve, and the carry trade forces a massive liquidation of U.S. Treasury bonds, we hit the ultimate doomsday scenario for the American economy.
A spike in long-term U.S. interest rates.
And David Lynn did not mince words when discussing this outcome. He stated that a sudden uncontrolled spike in the long end of the U.S. yield curve, specifically the 10-year and 30-year Treasuries, would be the economic equivalent of a nuclear bomb.
And the raw data backs up that stark language. Look at the balance sheet.
Yeah, the U.S. debt to GDP ratio is currently hovering at 122%.
Which is staggering.
To put that into historical context, that is a heavier debt burden than the United States carried at the peak of World War II.
Think about that.
It has quadrupled as a percentage of GDP just since the 1980s.
The sheer physics of a debt pile that large changes the way an economy functions. At $35 trillion in total national debt, the cost of simply servicing it, just paying the interest, is now eclipsing $1 trillion annually.
$1 trillion just in interest.
Yes. The U.S. government is now spending more money just paying interest to bondholders than it spends on the entire Department of Defense.
And let's keep in mind, the U.S. defense budget is larger than the defense budgets of the next 10 countries combined.
Right.
This brings us to why the U.S. Treasury is currently heavily issuing short-term debt, like T-bills, rather than locking in long-term 30-year bonds. Secretary Yellen's strategy has been to ride the short end of the curve, hoping rates come down before the bulk of the national debt has to be refinanced.
But it makes the U.S. government hypersensitive to immediate liquidity shocks. It creates a sovereign debt trap.
How so?
Well, if the Japanese carry trade unwinds and foreign holders dump treasuries, the yield on the 10-year bond could easily rip past 5% or 6%.
Right.
If the U.S. government has to roll over trillions of dollars of maturing debt at 6% interest, the math just breaks.
The interest expense would rapidly consume all incoming tax revenue.
Exactly. Forcing the government to either slash entitlement programs to zero, which is politically impossible.
Yeah, never gonna happen.
Or print trillions of new dollars to monetize the debt, which triggers hyperinflation.
And this nuclear bomb doesn't just hit the government, right? The fallout irradiates the consumer instantly. Every form of consumer credit is benchmarked against the U.S. Treasury yield.
Every single one.
If the 10-year yield spikes, credit card APRs shoot past 30%. Auto loan defaults cascade. David Lynn used the Canadian mortgage market to illustrate how fast this pain translates to the middle class.
The Canadian housing market is a perfect canary in the coal mine for yield curve sensitivity.
Explain that, because it's different than the U.S.
Right. In the U.S., the standard is the 30-year fixed-rate mortgage, which somewhat insulates existing homeowners from sudden rate shocks. But in Canada, the standard structure requires homeowners to refinance their mortgage rate every 5 years based on current market conditions.
Lynn noted that when rates ticked up globally over the last 18 months, Canadian homeowners coming up for their 5-year renewal saw their monthly mortgage payments double.
And in some cases, triple overnight.
That's terrifying. Families were forced into distress sales simply because the macro interest rate environment shifted beneath their feet.
And a spike in U.S. long-term yields would replicate that exact dynamic across the entire American corporate debt landscape and consumer credit markets.
So to prevent that economic nuclear bomb from detonating, the Federal Reserve and the Treasury are backed into a corner where they must deploy yield curve control.
YCC.
Right. Let's unpack YCC, because it's a term that gets thrown around in financial circles but rarely explained mechanically. Historically, direct yield curve control hasn't been utilized in the United States since the 1940s.
Since World War II.
Exactly. During the war, the government needed to issue an unprecedented amount of debt to finance the war machine. They couldn't afford the free market dictating high interest rates on those war bonds. So the Federal Reserve simply announced a hard peg. They capped long-term rates at 2.5%.
And the mechanism of a hard peg is brute force money printing. The central bank publicly commits to buying an infinite amount of government bonds at a specific price to enforce the yield cap.
Right.
If the market tries to push the interest rate to 3%, the Fed creates billions of dollars out of thin air and buys every bond in sight until the rate falls back to 2.5%.
It is the ultimate suppression of free market price discovery.
It absolutely is.
But David Lynn's analysis argues that while we don't have a formal direct YCC policy announced by the Fed today, we are absolutely witnessing indirect yield curve control.
Oh, without a doubt. The $53 billion repo trick we discussed with Japan is the prime example.
Right.
By establishing back-channel liquidity facilities to prevent foreign central banks from selling U.S. treasuries, the U.S. is actively manipulating the supply side of a bond market to keep yields artificially capped.
And Jerome Blockland has a brilliant conceptual framework for this exact dilemma. He describes central banks as being caught in a spagat.
Yes, a spagat. It's a Dutch term.
What does that actually mean?
It translates to a split, or like a physical stranglehold. The central banks are being ripped in two fundamentally opposing directions.
Okay, lay them out.
On one side, their mandate is to fight inflation and maintain price stability. To do that, orthodox economics dictates they must keep interest rates high to cool demand.
Okay, that makes sense. But on the other side of the spagat,
On the other side, they are tasked with preventing a sovereign debt collapse. To maintain debt stability for a government levered at 122% of GDP, they absolutely must keep interest rates low.
so they cannot have both.
No, it is the ultimate macroeconomic catch-22.
If we connect this to the bigger picture, Blockland's thesis is definitive. When the system is pushed to the absolute brink, debt stability will always win.
Always. Sovereign governments will always choose the silent theft of inflation over the violent catastrophe of a hard default.
They will cap the bond yields through direct or indirect YCC, and they will just let inflation run hot to slowly melt away the real value of the debt burden.
That's the playbook.
So if central banks are fundamentally trapped, and the major fiat currencies, the dollar, the yen, the euro, are all, as Blockland eloquently puts it, weak horses in a race, being ridden by jockeys desperate to debase them, where is the smart money allocating capital to survive the debasement?
The capital is fleeing into the historic ultimate hedge against currency debasement. Yes, gold. The market action in gold over the past several months is the clearest signal that institutional investors are positioning for this exact scenario of sustained financial repression.
And the price action in physical gold has been violent. And I use that word intentionally because gold is traditionally a sleepy, low volatility asset.
Very sleepy. But over the summer, gold futures surged 14 to 15%.
Yeah, and in early August, perfectly synchronized with the unwinding of the yen carry trade, gold spiked a massive 6% in just 2 trading days.
A 6% move in 48 hours for a multi-trillion-dollar physical commodity is a tectonic shift in capital allocation.
And the bid isn't just coming from retail investors buying coins, right? The foundational support is coming from the central banks themselves.
Exactly. The People's Bank of China, along with central banks in India and Eastern Europe, have been hoarding physical gold at record paces.
Even when China officially paused their reported gold purchases recently, market analysts widely suspect they continue to accumulate massive tonnage through state-owned proxy banks.
Of course they are. To understand why gold behaves this way, we have to walk through the mechanics of real interest rates, because this is the mathematical engine driving Blockland's entire investment thesis.
Okay, let's break down real interest rates for everyone.
It's pretty simple. Real interest rates are just the nominal yield of a bond minus the official rate of inflation.
Right. And gold is a unique, often polarizing asset because it has zero yield. It doesn't pay a quarterly dividend like a blue-chip stock, and it doesn't pay a coupon like a treasury bond. It is literally an inert piece of metal.
So in a healthy economic environment where the central bank is acting responsibly, the opportunity cost of holding gold is quite high.
Meaning you're missing out on other gains.
Exactly. If inflation is at 2% and a U.S. Treasury bond is paying 5%, your real interest rate is a positive 3%.
Yeah.
You are mathematically growing your purchasing power by holding the bond.
But if you choose to hold gold instead, you are actively forfeiting that 3% risk-free return.
Right. And in that environment, capital flows out of gold and into government debt.
But exactly the opposite happens when central banks are caught in the spigot. If the government realizes they cannot afford a 5% interest rate and they implement yield curve control to cap the bond yield at 3%.
But inflation is structurally running hot at 5%?
Your real interest rate is now negative 2%.
Negative. If you buy that government bond, you are locking in a guaranteed mathematical loss of purchasing power every single year.
So the opportunity cost of holding gold instantly drops to zero.
Exactly. In a regime of negative real yields and manipulated sovereign debt, gold stops being a yieldless rock and transforms into the most pristine collateral on Earth. It is the only financial asset that isn't simultaneously someone else's liability.
So what does this all mean for the traditional bedrock of retail investing, like the 60-40 portfolio?
Well, Blockland concludes that it's structurally compromised.
Wow.
For 40 years, financial advisors told clients to hold 60% equities for growth and 40% government bonds for safety. The bonds were the ballast.
Right. If a recession hit and stocks crashed, central banks would cut interest rates, bond prices would soar, and the 40% would protect the portfolio.
But if sovereign bonds themselves are the epicenter of the systemic risk, because governments must debase the currency to service them, the ballast is filled with holes.
Blockland argues that in a world of financial repression, holding a structural allocation to hard assets like gold is no longer a fringe macroeconomic bet. It is basic fiduciary common sense.
It's a massive paradigm shift. But whenever we discuss hard assets and currency debasement, we have to address the digital elephant in the room.
Bitcoin. I know half of the people listening to this are currently screaming at their dashboards, wondering why we are talking about ancient yellow metal instead of algorithmic scarcity.
It's a fair point.
The fundamental pitch for Bitcoin for the last decade has been that it is digital gold, a decentralized, mathematically capped asset designed explicitly to act as a life raft during fiat debasement.
Right.
So why isn't Bitcoin absorbing all of this panic capital?
It's a crucial question, and Blockland handles it with a lot of nuance. He is not anti-crypto. He acknowledges that the underlying cryptographic architecture of Bitcoin aligns perfectly with the need for hard money.
Okay, so what's the holdup?
His analysis focuses on how the broader market is currently treating the asset. Right now, institutional capital models Bitcoin strictly as a risk-on technology play, highly correlated to the NASDAQ, rather than a risk-off safe haven like physical gold.
So it trades based on liquidity and speculative momentum, rather than reacting cleanly to real interest rate metrics.
Precisely. The capital allocators who typically drive massive surges in Bitcoin are seeking rapid asymmetric wealth generation.
But in the current market cycle, that specific pool of speculative risk capital has been entirely hijacked by the artificial intelligence boom.
Yeah, AI is just sucking the liquidity out of the room. The institutions have finite risk budgets, and right now they're allocating those budgets to NVIDIA and OpenAI infrastructure, leaving Bitcoin to just chop sideways.
So, according to Blockland's framework, what is the catalyst that forces Bitcoin to decouple from tech stocks and actually assume the mantle of digital gold?
He theorizes that Bitcoin requires a much more severe, undeniable monetary fracture to trigger institutional adoption as a Treasury reserve asset.
Meaning, physical gold is moving now because central banks, the most conservative institutions on earth, are buying it.
Right. But central banks are not yet accumulating Bitcoin on their balance sheets. For Bitcoin to experience its next massive structural leg up, the broader market needs to realize that the central banks have completely lost control of the inflation mandate.
It requires the failure of the system to be so glaringly obvious that the risk of holding a volatile digital asset becomes lower than the risk of holding sovereign fiat.
Exactly. Although it is vital to mention a personal anecdote Blockland shared that highlights the micro-utility of Bitcoin today, regardless of its macro price action.
What was that?
He discussed the increasing friction of dealing with the legacy banking system in Europe. Accounts being arbitrarily frozen, international transfers held up for weeks in compliance reviews.
Oh yeah, the friction is getting worse.
And he experienced this profound realization that Bitcoin remains the only monetary network where the user assumes zero counterparty risk.
Because no commercial bank manager and no government bureaucrat can arbitrarily decide to block a properly signed peer-to-peer Bitcoin transaction on the base layer.
Exactly. You do not have to ask permission to move your own economic energy.
And in a future where sovereign governments become increasingly desperate to ring-fence capital and prevent wealth from fleeing their borders to avoid taxation.
That pure censorship resistance carries a massive premium, even if the dollar price of the asset is currently stagnant.
And that brings us to the sector that is actively draining that liquidity away from Bitcoin and seemingly ignoring all of the macroeconomic red flashing lights we've discussed so far.
The AI capital expenditure boom.
Right, the AI capex monster. The juxtaposition here is jarring. We are mapping out the fragility of the Japanese yen, their $14 trillion carry trade time bomb, and the U.S. debt trap, yet the S&P 500 and the NASDAQ have spent the entire year relentlessly grinding to all-time highs.
It feels disconnected, but David Lin's analysis strips away the illusion of a broad, healthy economic expansion.
Yeah, this equity rally is historically narrow. It is being brute forced by a tiny oligopoly of mega-cap tech companies funneling unimaginable sums of cash into AI capital expenditure.
The scale of the spending is difficult to comprehend. Lin cites data showing that AI capex across the hyperscalers Google, Microsoft, Amazon, Meta is up 72% year over year.
72%.
We are witnessing the most aggressive, capital-intensive infrastructure build-out in the history of human commerce, compressed into a 24-month window.
And to finance this build-out, The tech giants are pulling every lever available. Like NVIDIA, essentially the monopoly supplier of the shovels in this gold rush, recently established a $500 billion financing platform in partnership with major private equity firms.
Just to provide credit to companies buying their GPU clusters.
Meanwhile, Alphabet, Google's parent company, executed an $85 billion equity raise.
That Alphabet move is highly revealing. It is the largest corporate equity raise in U.S. history.
Wait, really? The largest ever?
Ever. And from a corporate finance perspective, if a company needs $85 billion to build data centers, they typically issue corporate debt.
But in this macro environment, borrowing $85 billion at elevated interest rates would devastate their free cash flow.
Exactly. So instead, they issued new equity. They capitalized on the fact that their stock price was near all-time highs, essentially printing new shares to raise the cash.
They diluted the ownership stake of their existing shareholders to feed the AI furnace.
And the stock price actually took a hit on the announcement because the market recognized the dilution.
It illustrates an intense, almost existential FOMO at the executive level. The CEOs of these companies are terrified that if they miss the window to achieve artificial general intelligence, their legacy search and software businesses will be rendered obsolete overnight.
They are willing to burn shareholder value today to ensure survival tomorrow.
But this hyper-concentration creates immense structural fragility in the broader stock market.
It does. Because the indices are market cap weighted, the entire S&P 500 is now effectively a leveraged bet on semiconductor demand.
And just as August 5th offered a preview of the carry trade unwind, mid-July offered a brutal preview of what happens when AI sentiment wavers.
The July semiconductor sell-off was vicious.
The SMH ETF, which tracks the broader semiconductor sector, plummeted 25% in a matter of weeks.
And the ripple effects demonstrated how interconnected this tech supply chain is with global leverage.
Like what happened in South Korea.
Right. Memory chip giants like SK Hynix, which supply crucial components for NVIDIA's AI clusters, saw their stock prices collapse.
And the fallout in Korea was uniquely severe due to the retail market structure there. South Korean retail investors utilize margin debt at much higher rates than their U.S. counterparts.
So when SK Hynix collapsed, it dragged down the entire Kospi index. The result was that 1.2 million retail brokerage accounts in South Korea faced margin calls and forced liquidations in a single month.
Over 1 million accounts wiped out because of a temporary dip in sentiment regarding American AI infrastructure.
Yeah.
It shows how fragile the leverage really is.
Now, the tech stocks rebounded significantly after that July plunge. The indices recovered.
But David Lin pointed to underlying data, analyzed by financial expert Thomas Hayes, showing a highly insidious dynamic occurring beneath the surface of the rebound.
Yeah, the volume data suggests that institutional investors, the algorithmic trading desks, and massive pension funds are actively using the retail enthusiasm to offload their positions.
Wow.
The retail investors, conditioned by the last decade of quantitative easing, are aggressively buying the dip, convinced that the AI rocket ship is a one-way ticket to wealth.
Meanwhile, the institutions are quietly rotating their capital out of mega-cap tech and into defensive sectors like consumer staples and utilities. The smart money is distributing their heavy bags to the retail public before the music stops.
Which begs the billion-dollar question, what actually stops the music?
Right. If this is a CapEx bubble, and given that the hyperscalers are spending hundreds of billions on infrastructure while generating a fraction of that in actual AI software revenue, it certainly has the hallmarks of what is the pin that bursts it.
Lin's analysis isolates the trigger, a slowdown in downstream B2B or business-to-business demand.
The entire financial model supporting NVIDIA's valuation assumes that the hyperscalers will build the data centers, and then every Fortune 500 company on Earth will pay massive monthly subscription fees for enterprise AI software.
But the reality on the ground is that enterprise integration is messy. Companies are paying premium fees for AI agents, expecting them to revolutionize their workforce productivity, and instead they're getting what some industry analysts have coined AI slop.
AI slop. I love that term.
It perfectly describes it. It's the realization that while large language models are incredible at synthesizing language, they confidently hallucinate incorrect data. They struggle with complex, multi-step logical reasoning.
And ultimately require so much human oversight that the promised efficiency gains never materialize on the balance sheet.
When a logistics company or a law firm runs a 12-month pilot program with enterprise AI and realizes the ROI is negative, they won't renew the massive software contract.
And when software revenue stalls, Microsoft and Google will abruptly cancel the purchase orders for the next generation of data centers.
And when CapEx halts, the demand for NVIDIA GPUs crashes. Because semiconductors are a notoriously cyclical boom and bust industry, the contraction will be violent, dragging the entire equity market down with it.
We are already seeing the leading edge of investor fatigue regarding CapEx spending without clear revenue models.
Lynn highlighted the scrutiny on Elon Musk's allocation of resources to show this.
Right, with SpaceX. SpaceX recently posted phenomenal revenue growth from its core aerospace and satellite launch businesses. But the private valuation took a hit because investors discovered Musk was diverting substantial profits from the rocket business to fund massive GPU purchases for Grok, his AI chatbot startup.
Institutional investors are looking at the balance sheet and asking, why are you taking our aerospace profits and burning them in a data center to train a chatbot that tells jokes on a social media platform?
When that localized skepticism spreads to the broader market, the CapEx cycle breaks.
And this is the massive intellectual pivot in Lynn's thesis. What if the skepticism is wrong?
Here's where it gets really interesting.
What if the CapEx isn't a bubble, but the necessary birthing pangs of a technology that actually delivers on its world-altering promises?
This leads us to the most profound extrapolation in the source material, where we connect the AI boom all the way back to where we started this discussion, Japan.
This is where we cross the Rubicon from macroeconomics into societal architecture.
Because to understand why AI is viewed as an existential necessity by global elites, you have to look at Japan's original sin. The root cause of their decades of economic stagnation, the reason they are trapped in the zero-interest rate carry trade to begin with, isn't just poor fiscal policy.
It is demographics.
Japan is the leading indicator for the demographic collapse of the developed world.
Lynn shared the stark demographic data. Japan's working-age population peaked roughly 30 years ago in 1995 at 87 million citizens.
Okay.
Today, that productive workforce has shrunk to 73 million, and it continues to plummet.
From a purely mathematical standpoint, a capitalist economy cannot grow if the pool of citizens producing goods and paying income taxes is rapidly shrinking, while simultaneously a massive and growing elderly population is drawing heavily on state pensions and healthcare resources.
It creates a structural deficit.
The government is forced to print money to fill the gap, which debases the currency, which leads directly to the yen crisis we dissected earlier. It is an inescapable demographic doom loop.
And Japan is first, but Western Europe, South Korea, and eventually the United States are on the exact same demographic trajectory.
This is where the techno-optimists in Silicon Valley interject. They look at this demographic collapse and posit that artificial intelligence and humanoid robotics are the only mathematical salvation.
The theory is that if we are structurally short 15 million human workers, we simply replace them with AI agents and autonomous robots.
If the technology can boost the productivity of the remaining human workforce by 1,000%, you can theoretically generate enough economic output to support the aging population without relying on currency debasement.
It sounds like a utopian solution, but David Lynn meticulously dismantles the economic paradox hidden inside this vision.
Replacing human labor with hyper-efficient AI does not solve the economic equation under our current model of capitalism.
No, it fundamentally breaks the velocity of money.
Break this down for us because it challenges the fundamental assumption of the tech industry. Why does infinite productivity break capitalism?
Well, capitalism requires consumption. An economy only expands if humans remain in the labor force, earning wages for their time, and then turning around and spending those wages to consume the goods and services the economy produces.
Right.
If humanoid robots, which companies like Tesla and Figure are advancing at a staggering pace, and AI agents become so sophisticated that they replace the vast majority of human jobs, the economic feedback loop shatters.
Because if the robot takes my job, I have no income.
Exactly.
And if I have no income, I have no purchasing power. It doesn't matter if the AI can manufacture a car or write a piece of software for pennies on the dollar. If the consumer base has zero wages, there is no one to buy the product.
The economy grinds to an absolute halt in a paradox of extreme abundance and extreme poverty.
Which leads Lynn to project a highly plausible, albeit chilling, base case for the near future. An economy defined by pure, unadulterated centralization.
He envisions a landscape where a tiny oligopoly of tech behemoths monopolizing the compute power and the robotic fleets generate practically 100% of global economic output.
Small and medium-sized businesses are entirely eradicated because a local accounting firm or a regional manufacturing plant simply cannot compete with the absolute zero marginal cost efficiency of an AI swarm.
The wealth generated by this system becomes hyper-concentrated in the hands of the few individuals who own the proprietary models and the data centers.
Now, the standard historical counterargument to this doomsday labor scenario is the Luddite fallacy.
Right, people always point back to the Industrial Revolution.
When the combustion engine and the tractor were invented, 90% of the population worked in agriculture. The tractor arrived, replaced the farmers, and everyone panicked, predicting mass starvation and permanent unemployment.
But the farmers didn't go permanently unemployed. They migrated to urban centers and found work in factories, building the very machines that replaced them, or they moved into newly created service industries.
The argument is that technology destroys jobs, but it creates entirely new categories of labor that we simply lack the imagination to predict right now. Why won't we just all become prompt engineers or robot fleet managers?
Lynn addresses this directly by leaning on a foundational concept of Ricardian economics: the distinction between comparative advantage and absolute advantage.
Explain the difference.
The tractor possessed a comparative advantage over the human farmer. It was exponentially better at the specific task of pulling a heavy plow through dirt.
But the human retained an absolute advantage in complex physical dexterity, cognitive reasoning, and adaptability.
Exactly. The human could retreat to the factory floor or the office desk where the tractor was useless.
There was still a vast domain of labor where only a human could function.
Exactly. But the stated goal of the companies building artificial general intelligence is to create systems that possess an absolute advantage across all domains, both cognitive and physical.
If a humanoid robot equipped with advanced tactile sensors is a faster, safer, and infinitely cheaper electrician or surgeon,
And an AI model is a more accurate coder, lawyer, and quantitative analyst.
there is no higher intellectual or physical ground for the human worker to retreat to. It is a total usurpation of the concept of labor.
If human labor hours no longer translate to wealth accumulation because an algorithm can replicate your entire lifetime of acquired skills for a fraction of a cent in compute cost, the foundational social contract of the modern world dissolves.
The premise that hard work guarantees upward mobility ceases to be mathematically true.
Faced with a population that is permanently unemployable but still requires food, shelter, and energy, the state has only one viable mechanism to prevent mass starvation and violent societal collapse.
Universal basic income, or UBI?
Yes, UBI. The government will be forced to implement an aggressively redistributive tax policy.
They will have to extract the wealth generated by the hyperproductive AI megacorporations and distribute it directly to the obsolete human population, purely to maintain a baseline level of consumption so the economic engine doesn't seize up.
Following the logic of this transition, David Lynn describes this endgame scenario as the purest form of socialism that Marx could envision.
And looking at the geopolitical realities, Lynn is making this extrapolation strictly by following the mathematical endpoint of the technology, not as a political endorsement.
No, not at all. He is identifying that extreme technological capitalism, pushed to its absolute limit of efficiency, ironically necessitates a massive state-mandated redistribution of wealth just to survive its own success.
It requires a profound psychological shift. We would be transitioning from a civilization where your identity and survival are inextricably linked to your economic output, to a society where the state provides for your baseline existence, and human pursuit shifts entirely toward leisure, philosophy, or localized community building.
But in the messy transition phase, before we reach that post-scarcity utopia, is there any economic value left for a human to capture?
If you are a young professional looking at this landscape today, is there any moat you can build around your career?
The analysts synthesizing these trends believe there is one remaining moat, and paradoxically, it is something an algorithm is fundamentally incapable of manufacturing.
Genuine, verifiable human imperfection and trust.
It is a fascinating thesis on the future of premium value. The trajectory of AI ensures that we are about to be flooded with a tsunami of mathematically perfect, zero-cost synthetic media and services.
The AI will write the structurally flawless screenplay, generate the perfect marketing copy, and deliver the perfect corporate presentation without a single stutter or hesitation.
But humans are biologically wired to seek out friction and connection with other humans.
When you listen to a conversation and someone stumbles over a thought, or an interviewer asks a slightly unpolished, vulnerable question, it acts as a cryptographic signature.
It proves reality. It proves there's a beating heart and a lived experience on the other side of the exchange.
In a world where absolute perfection becomes a cheap, ubiquitous commodity generated by server farms, Knowing that a product, a piece of art, or a piece of advice comes definitively from a human will become the ultimate luxury good.
Personal branding, face-to-face physical community building, one-on-one coaching, and high-trust advisory roles, these are the domains that will command a massive premium.
Trust becomes the scarcest asset in an economy defined by infinite synthetic abundance.
So tying this massive diagnostic X-ray together into a cohesive picture.
We started by looking at a desperate, multi-billion-dollar currency intervention orchestrated in the middle of the night to prevent the Japanese yen from collapsing.
We unspooled how that intervention was necessary to prevent the detonation of a $14 trillion carry trade built on the assumption of infinite 0% interest rates.
We explored how the unwinding of that trade threatens to trigger a spike in long-term U.S. interest rates, exposing the catastrophic reality of a sovereign debt pile that now costs over $1 trillion a year just to service.
This mathematically forces central banks into a spigot, guaranteeing future currency debasement and indirect yield curve control, which is driving institutional capital to aggressively hoard physical gold as the ultimate safe haven.
And we contrasted the fragility of that macro debt landscape with the relentless, FOMO-driven euphoria of the AI capex boom, a tech bubble that is simultaneously holding the stock market at all-time highs while quietly laying the robotic and algorithmic groundwork that could render the entire concept of human labor obsolete.
It is a landscape of extreme contradictions.
But the actionable advice synthesized from both David Lin and Jerome Blockland is remarkably grounded.
They suggest navigating this transition with a two-pronged approach. First, aggressively accumulate hard, decentralized assets now, while the window of traditional capital accumulation is still open and the currency hasn't fully debased.
Build your financial fortress before the AI megacaps completely consolidate global output.
And second, ruthlessly cultivate genuine human trust in your professional and personal life. Invest in physical communities, build deep, verifiable relationships, and lean into your own vulnerability.
Because in a future dominated by flawless, hyper-efficient machines, your messy, empathetic humanity will be the only absolute advantage you have left to trade on.
Which leaves us staring at a massive chronological collision. This raises an important question.
If the AI optimists are right, and artificial intelligence eventually delivers a post-scarcity, hyper-productive utopia that bails us out of our demographic decline, but our current global fiat and sovereign debt architecture is mathematically poised to collapse under the weight of $14 trillion of hidden leverage before that technology is fully mature.
Which side of that chaotic timeline are you positioned for?
Will the sovereign debt bomb detonate, vaporizing fiat purchasing power before the AI savior arrives to rebuild the system?
It is a race between the collapse of the old financial plumbing and the installation of the new digital architecture.
Something to mull over as you review your own portfolio and your own career trajectory. Reading the diagnostic X-ray of the global economy isn't about finding a clean break anymore. It's about realizing the X-ray machine is plugged into a wall socket that is sparking, the hospital is leveraged to the hilt in Japanese yen, and there is a humanoid robot waiting in the hallway to take the radiologist's job.
It is murky, it is highly complex, but aggressively untangling these hidden mechanics is the only way to survive the transition.
Thank you for joining us on this deep dive into the source material. We'll see you next time.